cover the economic effect on stocks. Here are our group members. And our topic was to discuss how the global economic conditions can affect the stock price of a firm. Here's an example of BP. Back in April, May, its stock price was around $484. Over the next 5 months, 6 months, the stock price dropped to around $320. So what kind of economic conditions can cause this type of thing to happen? We'll have specific examples later. First, we have interest rates. These are covered by the central bank and are the fundamental level all of their interest rates are based upon. They're used to work against inflation and can also be decreased in order to allow more capital to be borrowed by corporations. Next, we have economic trend. A market is generally going to be going up or it's going to be going down. When it's going up, it's called a bull market. When it's going down, it's called a bear market. Third, we have changes in economic policy. This is when a government decides that it wants to either support or go against a sector of the economy. This can be done through either subsidies, encouraging a sector to grow, or it can be done through additional regulation or taxes, decreasing the growth of an industry. Next, we have economic and political shocks. These can range from someone winning an election that wasn't expected to, all the way to a drought affecting a region or terrorism. Exchange rates. If your currency increases in value, suddenly your exports look less desirable to other countries, while other countries' imports look more desirable and cheaper than even possibly what you have in your country. Then you have inflation and deflation. Basically, inflation is the increase of the cost of goods, and deflation is the decrease. So you can see we have interest rates. In 2009, the Fed lowered interest rates to the lowest they've ever been, under 0.5%. And from there, we can see that a bull market emerged. While it's not the only factor that contributed to it, it was a significant change that allowed the economy to begin to grow again. As the cost to take out a loan decreased, more corporations were willing to take that risk and expand using cheap loans. And then a bull market emerged. And that has continued so far until today. Next, we have economic policy. This is for Tenet Healthcare, but it also went along with the S&P 500. On this day, the healthcare sector was the only sector that was positive. So what happened? The Supreme Court in June had to hear another case on Obamacare, specifically on the subsidies within Obamacare. The Supreme Court ruled for it, allowing it to remain in the bill. And because of that, you can see that within almost a 15-minute period, healthcare stocks went up. Tenet went up 11%, and others did even better. Next, we have economic and political shocks. This is for different terrorist actions that have happened over the last few decades. You can see that in the short run, we have a couple percent decrease in each of the indexes. In the long run, after about a month, those decreases have disappeared. Generally, the market has returned back to its original bull or bear market stance. Next, we have exchange rates. You can see here we have Japanese yen to US dollar, and then we have Toyota's stock price. As the Japanese yen fell in value to the dollar, Toyota's stock price increased. So why did this happen? Toyota, while it has much of its production in the US, continues to make vehicles in Japan. When the yen fell in value, those vehicles made in Japan were now cheaper. Toyota is able to ship those to the US, and from there their margins increased. The cheaper car sold for the same amount equals a larger margin. So next we have inflation and deflation. When interest rates, which are tied very tightly to the inflation rate, are increased, it costs more. Investors expect a higher return. So a corporation has two choices. It can either figure out how to increase its revenues instantly, or its price is going to have to decrease in order to maintain its price-to-earnings ratios. So another item that I found during my research is there's two different indexes. The CPI, Consumer Price Index, and the PPI, Producer Price Index. The Consumer Price Index is basically the inflation. It measures the inflation that consumers are being affected by, and then Producer Price Index is the inflation producers are being affected. So you can see back in October 2001, producers had a lower inflation rate. Their prices were increasing less than consumers. So this means that producers had their margins increase. So the next thing that we begin to see is that the S&P 500 increases right afterwards. And then we have the opposite effect. Back around the end of 2007, we can see that producers' prices increased while consumers stayed low. Margins decreased. While this wasn't the only factor that went into the 2008-2009 economic crisis, it possibly is a contributing factor, as we can see that stock prices once again fell. And that's all. Thank you very much.